A new trade war is brewing, and this time it could shake the foundations of the global economy. President Donald Trump has reimposed aggressive tariffs on Chinese imports, some exceeding 100%, reigniting tensions between the two largest economies in the world. China has responded with its own wave of tariffs, vowing to fight to the end rather than give in to what it calls American coercion. This isn't just political posturing. It's a clash that could trigger global economic aftershocks. Together, the United States and China make up more than 40% of the world's GDP. Their economies are tightly interwoven into global trade networks, and any disruption between them can spill over into every corner of the world. From the smartphones in your pocket to the food on your table, the effects of this escalating standoff could hit closer to home than most people realize. So what happens if this trade war spins out of control, and how might the rest of the world pay the price? Trump's China. The U.S. has seen its reliance on China for imports decrease over the past decade. Since 2016, the share of U.S. imports from China has dropped significantly, from 21% to just 13% last year. The trade war, including tariffs, has reshaped this dynamic. However, the tariffs have also led to some goods being rerouted. For example, Chinese manufacturers, especially in industries like solar panels, have moved their production to Southeast Asian countries like Vietnam and Malaysia. From there, these goods are shipped to the U.S., bypassing some of the tariffs originally imposed on China. Despite these changes, tariffs continue to have a significant impact. U.S. companies now face higher prices on products ranging from solar panels to electronics and even vehicles. In fact, the tariffs on solar panels in 2018 contributed to the increase in prices for clean energy systems across the U.S., impacting both businesses and consumers. Another major issue is the impact on major U.S. corporations, including tech giants like Apple. The tariffs on Chinese goods, particularly smartphones, have been one of the main contributors to the recent 20% drop in Apple's stock price over the past month, with 9% of U.S. slung imports coming from Chinese-made smartphones. This is a significant blow to companies heavily dependent on Chinese production. But what's the broader impact of this trade conflict on global markets? China and the U.S. together make up a staggering 43% of the world's GDP. Any slowdown or recession in these two economies will ripple throughout the global market. A prolonged trade war could trigger slower global growth, particularly in emerging markets. Economies that are heavily dependent on trade with China and the U.S. could see their own growth stunted. Countries in Southeast Asia, Africa, and Europe are all at risk of feeling the pressure as the world's two largest economies struggle to maintain momentum. Additionally, China, as the world's biggest manufacturer, produces far more than it consumes domestically. With an almost $1 trillion goods surplus, China relies heavily on exports to the global market. If U.S. tariffs cut off a major source of revenue, Chinese firms could look to dump these goods in other markets. For example, Chinese steel, produced at below-cost prices due to state subsidies, could flood markets like the UK, potentially undercutting local producers and putting jobs at risk. Such dumping may benefit consumers with cheaper prices, but it could destabilize global markets, threatening jobs, wages, and long-term economic stability in other nations. Economists are generally in agreement that the impacts of an all-out trade war between the U.S. and China would be highly negative for the global economy. The direct trade effects are severe, but the long-term consequences, especially on global supply chains and investments, could cause a prolonged downturn. The tariff impact and trade shifts. Trump's tariffs were supposed to make China pay, but here's the twist. Instead of taking a hit, Chinese manufacturers simply moved their production to Southeast Asia. Countries like Vietnam, Malaysia, and Thailand are now playing a big role in getting those same Chinese-made products to the U.S. However, the story doesn't end there. The U.S. quickly caught on to this shift and began imposing new tariffs on these countries as well. So what does that mean for consumers? Higher prices. Solar panels, electronics, vehicles, you name it, the cost is climbing. You may think you're avoiding the impact of Chinese tariffs, but in reality, you're feeling it in your wallet. What was once a cheap Chinese-made product now comes with a higher price tag because of the tariffs on goods being rerouted through these Southeast Asian countries. These changes might seem like a temporary fix, but in the long run, they're only adding to the burden on consumers who are already feeling the pinch of inflation. It's not just about China anymore. Now, the entire global supply chain is under pressure, and that pressure impacts on U.S. corporations. Take Apple, for example. With the tariffs on Chinese goods, Apple's stock took a nosedive, dropping by a staggering 20% in just a month. Why? Because 9% of U.S. imports are smartphones made in China. And as the cost of these imports rises, the market feels it. Higher production costs mean tighter profit margins, which shakes investor confidence and triggers stock sell-offs. But it's not just Apple. Across the board, major U.S. corporations are feeling the squeeze. Tech companies that rely on Chinese components, automakers importing essential parts, even clean energy firms dependent on solar technology, they're all facing rising costs and supply chain disruptions. This pressure translates into slower growth, delayed product releases, and price hikes for consumers. The tariffs that were meant to bring manufacturing back to the U.S. are instead creating uncertainty, reducing competitiveness, and forcing companies to rethink their global strategies. And as corporate giants wobble, so does the broader economy, broader global economic impact. Here's where things get even more interesting. Together, the U.S. and China account for a jaw-dropping 43% of global GDP. A slowdown in these two economies isn't just bad news for them, it's a nightmare for the entire world. Emerging markets, particularly in Southeast Asia, Africa, and Europe, are already feeling the heat as the economic titans struggle. Countries that rely on exports to China or depend on U.S. investment are seeing reduced demand, currency volatility, and slower growth. Factories are scaling back, jobs are at risk, and governments are scrambling to adjust budgets as revenue projections shrink. The ripple effects are also unsettling global financial markets. Investors, wary of prolonged instability, are pulling out of risky assets and turning to safe havens like gold and the U.S. dollar, creating more pressure on emerging economies with already fragile currencies. This trade war isn't contained. It's leaking across borders, disrupting supply chains, shaking investor confidence, and threatening to drag the world economy into a new era of uncertainty. China's manufacturing surplus. China's a manufacturing powerhouse, but it's facing a problem, one that's getting harder to ignore. It produces far more than it can consume domestically. With a nearly $1 trillion goods surplus, China depends on exports to keep its massive industrial engine running. But with Trump's tariffs threatening one of its biggest revenue streams, the U.S. market, China is being forced to look elsewhere. So, what's the strategy? Flood other countries with cheap goods. This tactic, known as dumping, allows China to sell products like steel, electronics, and solar panels at extremely low prices, often below the cost of production, thanks to generous state subsidies. While consumers in countries like the UK or India might enjoy cheaper prices in the short term, the long-term consequences are far more damaging. Local manufacturers can't compete. Factories close. Workers lose jobs. Entire industries risk being wiped out. It's a high-stakes game. On one side, an economic giant trying to stay afloat. On the other, global markets struggling to defend their own industries from collapse. And the ripple effect of this dumping could destabilize entire regions. Economic dumping and market instability. Imagine this. A surge of Chinese steel arrives in the UK, sold at prices so low, local producers can't match them. Why? Because Chinese manufacturers benefit from heavy government subsidies, allowing them to produce and export goods below market cost. At first glance, it seems like a win for consumers. Cheaper products? Sounds great. But scratch the surface, and the picture darkens quickly. Local manufacturers begin to suffer. Factories cut production or shut down entirely. Skilled workers lose their jobs. Towns that once relied on these industries begin to decline. And this isn't just happening in the UK. Similar stories are playing out across Europe, Africa, Southeast Asia, and beyond. Countries are suddenly grappling with waves of underpriced imports that threaten their domestic economies. What begins as economic dumping can spiral into a global issue, fueling wage suppression, yet destabilizing industries, and stalling long-term economic growth. It's a chain reaction that doesn't just hit balance sheets, it hits livelihoods. And the worst part, the damage is often hard to reverse. The experts weigh in. Economists are virtually unanimous in their assessment. A full-blown trade war between the U.S. and China would be nothing short of disastrous. In the short term, the consequences are obvious. Higher prices, disrupted supply chains, and market volatility. But it's the long-term impact that truly worries experts. Global supply chains, years in the making, could fracture, pushing companies to reassess and relocate production. That's not just costly, it's time-consuming and unpredictable. Investments, they begin to stall. Businesses hold off on expansion. New projects get shelved. Markets that thrive on stability become paralyzed by uncertainty. And once confidence is shaken, rebuilding it isn't easy. Some analysts warn that if this conflict deepens, we could be looking at a prolonged downturn, one that stretches well beyond U.S. and Chinese borders. As the world's two largest economies dig in for a trade fight, the global economy braces for impact. Shifting trade dynamics. So where does the U.S. stand now? A decade ago, China was the backbone of U.S. imports, supplying over 21% of the country's foreign goods. Fast forward today, and that number has dropped to just 13%. On paper, it looks like a significant shift, a deliberate move away from reliance on Chinese manufacturing. But the real question is this a permanent change in U.S. trade strategy or just a temporary detour? Many of the goods once labeled made in China are now arriving from Vietnam, Malaysia, Thailand, and other Southeast Asian nations. The supply chain has been redirected, but not necessarily rebuilt. The origin may have changed, but the economic reliance remains deeply entangled. Experts caution that unless there's a structural overhaul in how and where U.S. companies source their products, these shifts may not be as transformative as they appear. They could be tactical responses to tariffs, not long-term strategy. The future of U.S. trade policy hangs in the balance, and the outcome will shape global markets for years to come. Shrinking dependence or just a detour? While it may look like the U.S. is cutting ties with China, the reality is far more complex. Yes, direct imports from China have declined, but Chinese goods haven't disappeared. They've just found a new path. Manufacturers are shifting production to countries like Vietnam, Malaysia, and Thailand, exporting the same goods under different labels to sidestep tariffs. It's not a severing of trade, it's a rerouting. This tactic worked for a while, but Trump's latest wave of tariffs has caught up with the strategy. These new measures don't just target China, they hit Southeast Asian countries too. The result? Even if the tag says made in Vietnam, the supply chain may still lead back to China and the tariffs still apply. For U.S. consumers, that means one thing: higher prices. From electronics to solar panels to vehicles, the cost of everyday goods continues to rise. So has the U.S. really reduced its dependence on China? Or is it just taking the long way around? The global ripple effect. So what does this mean for the rest of the world? As China and the U.S. struggle, the entire global market feels the impact. Southeast Asia, Africa, and Europe all face growing economic pressure. Countries that rely heavily on trade with either of these giants are now staring at a slowdown, and many may not have the economic resilience to weather the storm. Industries across the board, from tech to textiles, agriculture to automobiles, are bracing for long-term disruption. Investment flows are shifting, supply chains are under strain, and uncertainty is clouding forecasts around the globe. The U.S. China trade war is far from over. With tariffs now targeting multiple countries, the global economy is on edge. Whether this is just a temporary detour or the start of a lasting shift in global trade dynamics remains to be seen. But one thing's for sure, the ripple effects are real, and they're not going away anytime soon. What do you think? Will the U.S. and China reach a deal, or is this trade war only going to get worse? Let us know in the comments. And if you found this breakdown helpful, don't forget to like, share, and subscribe for more global economic insights.